my name's Edward Hillwood. I run our internet research team at Morgan Stanley covering Europe and emerging markets with my colleague Andrea Ferraz. Our job is to analyze the industry and try and select the best companies for investors to select for their investment portfolios and obviously ones to avoid. We typically operate within the public markets, but we also help companies in their route to IPOs. So it's our first time at NOAH today. It's great to see and hear so many great founders talking about their businesses. So instead, as representatives of the financial community, I thought we'd spend some time just talking about the internet sector in Europe, some key trends, some valuation, debates, and of course making a few predictions for the future, because that's what we like to do as analysts. The first thing I would say is at Morgan Stanley, we're the only bank who actually treats the internet sector as a whole in Europe. This is because we think it's approaching critical mass. The market capitalization of European internet's up to 70 billion euros. That's up double since 2012. There's been 8 IPOs in the space since 2014, and we think that's going to set to continue. In fact, there's been 3 in Germany, of which Berlin is now a central hub for activity on a European scale. In terms of investors, there's simply more choice for people now. We have 20 companies with $1 billion valuation in Europe. We have 6 major business models. We have companies from mature cash-generative companies, low growth, like Rightmove in the UK, through to loss-making businesses, or currently loss-making businesses at the moment, in the form of Rocket Internet and a few others. So there's more choice. However, the European internet space is still tiny relative to the US and China. Only 1% of funds in Europe are devoted to European internet investment relative to 4 or 5 in the US and China. So there's plenty to go for. In terms of share price performance, actually, the European companies are doing pretty well this year. The average internet stock globally has risen 20% globally, and Europe is actually up 24%, as you'll see on that chart. And this is broadly 50% of this performance has been driven by increased valuation, and around 50% has been driven by earnings beats. But of course, around 85% of European companies are up year to date, but there are some which are not. And when you're trading at 30 to 50% premium to the market, if you disappoint the market in terms of earnings trajectory, then you are disproportionately punished. In terms of valuation, there's a lot of talk about bubbles. Our view at Morgan Stanley is that selectively in some private transactions, in some areas such as social, possibly some geographies such as India, there may be some bubble-style characteristics, but there's absolutely no bubble in the European internet space. The valuations are very normal, and in fact, this is nothing like 2000, which I remember well, as our 14-man internet team was cut to just 2 at the time. And this is because investors want the same thing. So investors are basically benchmarking growth and cash flow at similar levels globally. So this chart is looking at marketplaces, and this is a global chart looking at EBITDA growth on the x-axis and valuation on the y-axis. You can see a very strong correlation there globally. If you look at e-commerce, the correlation breaks down because, of course, e-commerce is much more idiosyncratic. But indeed, we can explain the positioning of all the companies on the chart through either structural reasons or through profitability, as opposed to geography. And this is essentially because European investors want the same thing as everyone else. They want sustainable growth and cash flow. And at Morgan Stanley, we have 6 metrics we use to value and look at internet companies globally. The first is, of course, we look at addressable market and revenue sustainability. So there we look at business model, we look at market share, monetization ability, and scalability, and that gives us revenues. And then, of course, we're looking for great, unique economics. We're looking for high gross margins if we can get it. We're looking for a gap between acquisition costs and lifetime values, and feeding through into capital intensity, because at the end of the day, it's all about cash flow, and so CapEx, et cetera, is very important. But most important in all this is management. Investors are disproportionately valuing management over all else, management with a vision, management who can lead the company through the great challenges ahead. We are obviously, well, I'm an analyst, so we like to make predictions, and we thought we'd just make a few for 2016. If Marco invites us back, we can perhaps see if these have come true. So we've got 5 of them, just 5 trends we thought were important and what we're focused on now. The first is food. We think food is going to explode from an investor point of view in 2016. Consumers are ready to migrate, whether or not it be delivery, meal kits, takeaway, supermarkets, niche, click and collect. This area is going to be very big, and there's a couple of German companies in particular who are particularly exciting at this point, and we would expect possibly to even be public and grow very strongly next year. The second is US e-commerce. We're actually predicting an acceleration of growth in the US in 2016, not a maturing of the growth rate, which is very important. And that comes as the penetration rate of internet peaks at 20%. And that has very positive implications for European e-commerce. And we think the sector is just going to accelerate and get bigger. Thirdly, or second, the reason why European sector is smaller than the US is largely because the lack of global leadership of its peer group. So, in fact, in 2015-16, we've identified a few companies here who we think are going to be much bigger on the global scale, particularly in emerging markets, and in some cases in the US as well. And the prediction here is we just have more global leaders within Europe, driven by innovation and funding. The fourth prediction is emerging markets. Of course, emerging markets are growing very strongly, but we think they're going to significantly outstrip expectations in terms of current consensus. We see the merging of smartphone penetration, the leapfrog effect, if you like, the rocket internet strategy of leveraging the reduced gap between access, smartphones, and e-commerce penetration in emerging markets as assortment is prioritized over pricing. We think that's a big trend, and we think actually emerging market growth in areas like India will significantly outstrip people's expectations. And finally, marketplaces. Of course, marketplaces proliferating. We expect to see an acceleration of first-person to third-person models, and investors continuing to prioritize the very best marketplace models and to build and factor in greater sustainability of the business model. So, and of course, one final thing is whether or not it be delivery trucks or babies with mobile phone. Of course, the future is very much mobile. So we'd like to thank you from Morgan Stanley for inviting us here. And if anyone would like to speak to us about any company in the space or indeed any trends, please feel free to contact myself or Andrea. Thank you very much.